You are listening to The Vocal Technologist. Spoken tech for your ears.
If you've been watching the fintech space at all, you know it feels less like some smooth, orderly transformation and more like trying to rewire a city's electrical grid while it's still live.
That is a perfect analogy.
Yeah.
Because we are seeing these just foundational shifts in how money moves, who gets to assess credit, and maybe most importantly, who actually owns the pipes. It's chaotic, but it's also incredibly exciting.
It really is. And the material we've pulled together for you today, it just perfectly captures that speed. We're looking at everything from huge institutional shakeups to, new global regulations.
And the insane acceleration of AI, not just as a tool, but as a core part of the transaction itself. We're really looking at the shape of early 2026.
Right. And our job here is to cut through all that noise and get to what you really need to understand. Because right now there are, I think, two defining battles playing out. First, who owns the core financial infrastructure, the actual rails?
Yeah.
And second, how fast are AI agents going to go from being like a fancy chatbot to a fully autonomous financial decision maker? Because that shift, it just changes the economics of the entire industry.
It changes everything, exactly.
Yeah.
So let's jump in and see where the industry is drawing these new battle lines.
We have to start with the biggest piece of institutional drama, maybe of the last quarter. I'm talking about the Apple Card.
Yeah, the big handoff.
The big handoff, Goldman Sachs is out, and the absolute giant JP Morgan Chase is in.
And what's so fascinating isn't just the switch itself, it's the why. I mean, Goldman is an institutional beast, but they reportedly just struggled big time with the losses, the operational friction of high-volume consumer credit.
It's a totally different game than what they're used to.
It's a completely different game.
Yeah.
Running a card operation at that scale takes this just massive, hyper-efficient payments infrastructure and deep regulatory experience.
Things JP Morgan Chase has in its DNA.
Exactly. They're the largest U.S. bank by assets.
Mm-hmm.
They already own all of that. For them to step in, it's a huge signal of confidence. It basically confirms that mass market credit cards are a game for players who have decades of scale already built.
Which is the perfect lead-in to this broader trend we're seeing.
The charter race.
The charter renaissance. I mean, it's wild to think that America, for something like 15 years, just stopped making new banks.
Yeah, it effectively froze. But that has changed, and fast. Now fintechs are rushing to become fully regulated institutions.
So this is like the industry's coming-of-age moment.
It is a true coming-of-age moment. Getting a national bank charter, especially from the OCC, it's a pivot. It's a shift away from relying on regulatory workarounds and toward embracing real compliance and stability.
And it seems like it's creating two very different strategies for how to grow up.
That's right. Two distinct paths. The first one we're calling owning the rails. Think companies like Mercury, Stripe, and Circle.
And Mercury is a great example, right? They actually filed for an OCC charter. They even hired a former CFO from SoFi Bank to be the new bank's CEO.
They are all in.
Yeah.
And their goal is pretty clear. It's legitimacy, it's control, and it's better economics. If you can hold customer deposits yourself as an FDIC-insured bank,
you control your own destiny.
You control your capital costs, your compliance, your product roadmap. You're not paying those huge fees to a sponsor bank or playing by their restrictive rules.
Okay, but then you have the other side of the bet. The software wrappers. Isn't their whole argument that owning all that regulatory baggage is like a huge mistake?
That's the turf war.
Right. I mean, if the bank just becomes a commoditized pipe, doesn't that make the asset-light model like a Ramp or a Brexway more scalable in the long run?
That is the core of the debate. The wrappers Ramp, Brex, Novan, they're betting that the real value isn't in the plumbing. It's in the smart software, the expense management, the deep workflow integrons. They're happy to let someone else handle the regulated part.
So it's a split.
A huge split. Do you see banking as a utility you have to control or one you just need to consume efficiently? The next few years will tell us which model actually creates more value.
And that fight for control isn't just happening at home. We're seeing it on a global scale. Which brings us to Airwallex. Their big European play really stood out.
Absolutely. They're putting 200 million euros into the Netherlands.
200 million?
Yeah, over 5 years. They're beefing up their Amsterdam team and basically making it their hub for all of Europe. It's a direct shot at players like Adyen and Mali.
So this is a sign that the big fintechs are looking way beyond their home turf now.
It shows that to be a true global player, You need more than just a good API. You need deep, local, operational boots on the ground.
And while some are expanding, others are just getting bought. It seems like M&A is really heating up for 2026.
The optimism is definitely there. A KPMG survey we looked at showed that about 2/3 of deal makers expect more deals next year.
And not just more deals, but better ones, right?
Better quality deals, nearly 3/4 of them, which to me suggests we're moving past the frenzy buying of, unproven ideas.
Yeah, more strategic moves.
Exactly. The top drivers are pretty clear. Get into new markets, grow the core business, or just straight up acquire a technology you need.
But the risks they worry about are so traditional. Political uncertainty, regulatory crackdowns.
It just shows the market may be hungry, but it's also demanding serious discipline now.
That's the key word, isn't it? Discipline.
That discipline imperative defines this whole next phase. We are so far away from the growth at all costs vibe of 2021. Now it's all about hard trade-offs, showing a path to profitability, just demonstrating real depth. Look where the money is going.
Right.
Prediction markets like Polymarket and Kalshi raised a combined $3.7 billion. That cash didn't get sprinkled around. It went straight to the perceived leaders.
So investors are picking their horses.
They are picking winners who can prove they have profitable unit economics.
Which I loved because it connects to this warning we saw about not relying on AI magic to save you. The idea that the winners won't be the ones with the slickest demos. They'll be the ones who nail local execution, who own a deep workflow, and who've actually built trust with their customers.
Substance over sizzle.
Exactly, not just some fragile AI layer on top of a broken model.
And that shift from hype to function brings us right to AI. Because in 2026, AI has fully moved from the lab to execution. The focus is no longer on what if. It's on driving real, measurable financial outcomes at scale.
So when we say execution, are we still just talking about better data analysis, or are we talking about actual financial decisions being made without a human in the loop?
We're talking about replacing structured work. Full stop.
Okay, do me an example.
Look at Bank of America.
Yeah.
They rolled out an AI tool for cash flow forecasting. It analyzes a corporate client's transaction history, their liquidity, all the stuff a team of analysts would do.
And it automates the planning tasks.
Exactly. And the result, in 2025, it saved their corporate clients 250,000 hours.
Wait, 250,000 hours?
That's not just an efficiency gain. That is a structural revolution. It is replacing the repetitive middle office work that people have done for decades.
That is just a staggering number. It really feels like AI is going from an assistant to a player, from just chat to checkout.
It's absolutely moving beyond support. We're seeing these partnerships, PayPal with OpenAI, Stripe, they're turning a conversation into a transaction.
So the chat window literally becomes the checkout button.
Pretty much. You talk to an agent, and that agent can execute a complex payment right there, right then.
And the disruptive part of that is what it means for jobs. I saw Morgan Stanley estimate that AI could get rid of something like 200,000 banking jobs in the EU by 2030.
It's a huge number.
Yeah.
And it's targeting those specific roles back office, compliance analysis, transactional risk, all the standardized, predictable jobs that AI is just perfect for.
But if AI is doing all this work across different systems, how do they all talk to each other? That seems like a huge problem.
It's a massive coordination problem. If every bank and every payroll system has its own proprietary AI, they can't work together. You just end up with these walled gardens.
So you need open standards. The rails for the AI agents have to be universal.
Exactly right. Which is why this push for interoperability is so critical. You're seeing groups like the Agentic AI Foundation, the AAIF, popping up to create these shared standards.
So that an agent can talk to your bank, your payroll, and your payment system all at once.
Seamlessly. Without that, we're just building more digital silos, which kind of defeats the whole purpose. This is the vocal technologist, by the way, and we are definitely tracking those standards.
Let's stick with the rails for a minute, but shift to crypto. It feels like the consensus now is that blockchains and stablecoins only really win when they become invisible.
Yes. They succeed by hiding, by becoming the invisible infrastructure behind a real product that people want to use.
The users shouldn't even know they're using it.
They should just know it's faster or cheaper.
Yeah.
And this move toward maturity is forcing digital assets to finally start playing by the global rules.
And the regulators are certainly cementing that. The OECD's new framework, CIRF, seems like a really big deal.
It's critical for legitimacy. CIRF went live on January 1st. It forces crypto service providers in 48 countries to report user transaction data.
And by 2027, all those countries start swapping that data automatically.
Correct. It basically brings digital assets under the same global tax transparency umbrella that's existed for decades. It makes it much, much harder to hide transactions. It's the global cleanup.
Meanwhile, on the product side, it's all about speed, eliminating any and all waiting, like that loan on card solution for MasterCard and Loan Pro.
That's a brilliant piece of innovation. Think about traditional lending. You get approved, then you wait. For the ACH transfer to clear, it'd be a day, 2 days.
Right.
This gives a borrower instant access to the funds on a card credential. They can spend it immediately anywhere cards are accepted, but the loan still has those fixed repayment terms.
That speed is just becoming the table stakes now.
It's the absolute minimum expectation.
And we're seeing that embedded finance idea pop up everywhere. Stripe is working with Crypto.com now, letting users spend crypto directly without converting to fiat first.
Which removes all the friction. It's totally seamless.
And then in the physical world, you have Fiserv's Clover.
Right, with the biometric payments.
Yeah, partnering with Wink to embed face and palm payments right into the checkout terminal. Your face becomes your credit card.
It raises some really interesting questions about privacy versus pure convenience, doesn't it?
It definitely makes my wallet feel a little old-fashioned.
So when we pull it all together, what does this landscape really look like? I see 3 huge movements shaping 2026. First, this structural push for ownership. That's the bank charter race. Second, the market's pivot to discipline. Disciplined growth, strategic M&A, a focus on profit. And third, the functional rewiring of finance by AI. Agents moving from just advising to actually doing.
And when you connect all that, it brings up this huge question about consumer trust and just habits.
That's right. Especially when you look globally. In the West, we've never really managed to create a true financial super app like a WeChat or Alipay.
No, we haven't.
And some of the Money 2020 reporting really challenged whether AI on its own can change those deep-seated behaviors. In Asia, you're seeing this model of community finance orchestrators.
What does that mean?
It means they're pairing that super efficient AI with local human agents, trusted people in the community who act as the bridge, which makes you wonder if the West will ever get that digital consolidation or if our trust issues demand that kind of hybrid tech plus human model.
That is the core debate, isn't it? Raw technology versus human trust. And for a final thought, let's look at what happens when these newly disciplined fintechs try to go public. You've got Brazil's PicPay trying for a US listing again, now that their financials look better. But then you have Klarna.
Yeah, the lawsuit.
The class action lawsuit. It alleges they basically downplayed consumer credit risks in their IPO filings, saying they didn't disclose that a lot of their customers were already in financial trouble.
It's a serious allegation.
It is. So if the Klarna suit highlights the classic risks of aggressive lending and a lack of transparency, what happens when a fintech whose value is based on a complex black box AI model tries to go public? We want you to think about this. As the unit economics of AI get clearer over the next year, how will the market value these companies? Which pressure is going to win out? The hunger for that exponential AI performance or the absolute fundamental need for ethical transparency?
Spoken Tech for your ears.